Welcome to another video of Financial Indicators by Fahad M. Gohar. This is going to be the video number 15. The subject of today, it's very important indicator. It's called Cash Reserve Ratio, CRR. What does it mean? The cash reserve ratio is the percentage of a bank total deposit that must be, held in reserve and cannot be lent out or invested. This ratio is set by the central bank, like the Federal Reserve or the Reserve Bank, for example, like let's say Reserve Bank of India, to ensure, of course, liquidity of that bank and control money supply in the economy. Now, with of course the CRR, which is the cash reserve ratio, there is an acceptable CRR. This is determined of course by the central bank based on the current economic condition, inflation rate and growth target. It balances the need for liquidity with the control of course the inflation. With a higher CRR, government might prioritize controlling inflation, which may result in more conservative fiscal policy. Of course, during period of low CRR, government may focus on what? On growth policy, aiming to stimulate the economy through increased lending, and that will decrease the cash reserve. So now let's see the acceptable CRR and how we manage it. When we have a high CRR, which means a higher CRR reduce what? We reduce the fund available for banks to lend, which can help control inflation but may slow down economic growth. Okay, so when you have a high reserve, you reduce the fund available for those banks, so the banks don't have money to lend to other customer to invest into the economy. Okay, so now when you have a low CRR, which is a cash reserve, lower cash reserve ratio allow bank to lend out more money, which can stimulate of course the economic activity. However, it may also lead to inflation pressure if too much money is circulating in the economy. So you have to be throwing a balance here between those two. Now let's see the effect of high CRR, high cash being kept by the bank, on certain aspect of economy. Let's go with the first, the market confidence. Of course, a higher CRR might signal that the central bank is taking steps to control inflation, which could be positive or negative for market sentiment, depend on the economic condition. But usually the market confidence here will be going lower. How about the interest rate? Of course, a higher CRR, it does what? Reduces liquidity, which lead to what? To higher interest rate. Because you need you have a lot of cash reserve in the bank, so now you will have to increase the interest rate because you have reduced already the liquidity. Now the interest rate will go up. About the bond, what will happen to the bond? Of course, the bond price will fall. A higher CRR could result in higher interest rate, which will push bond prices down. Remember, higher interest rate, which means the newer bond will be more attractive, the older bond will be less attractive, so the bond prices will go down. Currency value, what will happen to it? The currency value here will increase. A high CRR can lead to a stronger currency due to a higher interest rate attracting foreign investment, so the currency value will go up. How about the government debt? What will happen to it? Of course, a higher interest rate increase the cost of borrowing, which will make government debt more expensive to manage. So the government debt will be less because the government don't want to borrow anymore because, you know, the interest rate is too high and it's too expensive to borrow. How about the corporate earning? What will happen to it? You know, company may find it harder to finance growth with more limited credit, of course. You know, that possibly lead to what? Reduced earning. So the corporate earning will go down. About the stock, remember stock and corporate earning are related. You know, stock definitely will fall. You know, a higher CRR, restrict lending, potentially reduce corporate growth, which will lead to a lower stock market performance. So stock market will go down. Remember, high CRR mean high, you know, money reserve ratio, the amount of money that the bank keeps. So now let's go with the low CRR, you know, so the banks is more, you know, flexible, you know, it's not, you know, reserving all the money and keep it into its, you know, location, but it allow it to be, you know, funneled to the general public or the investment. So let's go with the market confidence. Of course, a low CRR might boost market confidence, you know, during times of sluggish growth, as it signals a more accommodative monetary policy. So the market confidence will go up. How about the interest rate? You know, a low CRR, what will happen here? You know, you will increase liquidity in the banking system, okay, which can, you are now increasing liquidity in the banking system, which can reduce interest rate since banks have more fund to lend. So the interest rate will go down. How about the currency value? Of course, you know, currency value here will decrease. When interest rates are low, due to a low CRR, the domestic currency may depreciate as investors seek higher return elsewhere. So the currency value will go down. How about the government debt? Of course, lower interest rate makes it cheaper for the government to, you know, service its debt, which means it will borrow more. So now the government debt will go up. How about stocks? Of course, stock prices here will go up and rise. Banks have more money now to lend, which boosts corporate investment and earning. This leads, of course, to a rise in stock prices as investors expect higher future profit. So stock prices goes up. How about the corporate earning? Of course, corporate earning with easier access to loans, companies can invest in expansion, which will lead to what? To a higher earning. So the earning will go up. How about the bonds? Of course, the bond here will rise in their prices, increasing, you know, where increasing in money supply often lead what? To a lower interest rate. Lower rate can boost bond prices. Okay, so now we talked about how those aspects are affected with the high and low CRR, and here you can see it side by side, so you can visualize, you know, how to compare both sides. Let's see some charts that will give us some ideas. As you can see, impact of low and high CRR on economic factors, you know, stocks, bonds, interest rate, currency, you know, etc., etc. And you can see with the low CRR effect and the high CRR effect, and you can see the impact here. Okay, and you can see it again in a different way, and you can, this way you visualize, you know, how the impact level, economic factor, impact of low versus high cash reserve ratio, and economic factor. So this is for your own benefit to, you know, enjoy your knowledge and increase your knowledge by looking at these charts. So I hope this small video was beneficial for you to learn about the prospect of cash reserve ratio. I'll see you in the next video.